Well, I'm Sheridan Sims. I'm here with my good friend Brad Hacker.
Yeah, Brad Hacker here with Benchmark Mortgage, chilling out of my office today. So,
Thank you for letting us crash.
no, man, happy to have you guys.
So this will be a long form video, spun up into some shorts.
Okay.
What you and I have been talking about, spring 2026.
Coming up fast.
People are up, they're out, they're looking. So we want to go through and tackle some common questions.
Yep.
How to be prepared, how to win, and just generally good things to know to buy a house.
Yep.
You've done this how long?
23 years yesterday.
I love it. So wealth of knowledge. You and I share a lot of very similar viewpoints on how to buy, how to work in this market. So this will be geared for consumers.
Yep.
But I think also there's some things that agents could take away from this as far as things they could give back to their clients.
Yeah,
so
for sure.
I get asked this a lot. Sheridan, should buyers wait for rates to drop?
Yeah,
should I, as a buyer, wait for rates to drop to buy a house?
Yeah. I think the answer to that is no, particularly in our market here in Central Kentucky for a couple of reasons. Number one, when you just look at the really, really smart people who analyze mortgage interest rates over years and years. So you're talking about economists with National Association of Realtors or National Association of Home Buyers, Mortgage Bankers Association, and then the big investment houses, J.P. Morgan, Wells, Goldman. Almost universally, all of them are saying rates probably aren't going to really take any substantial drop until really most likely 2027, 2028. So I think that's the first piece of it. But I think one of the things that makes us unique nationally is just simply the fact that our houses really don't go down in value here. I mean, would you agree with that? We're not like a Nashville, Tennessee, or a Florida or a Vegas. We don't really see price depreciation here like you do in other markets, correct?
I would feel like we're insulated.
Yeah, because we don't build a whole lot of houses here, so we don't have a ton of new construction to compete with. And so we're actually seeing homes continue to appreciate. I think our local board of realtors predicted 4 to 5% this year over year. And so when you just do the math on it, you know, every 4% that a house goes up in value. So if I'm looking at that house at $300,000 today and it goes up in value 4%, that house is going to be $312 next year. Well, if rate drops 0.5%, that's a wash.
Yeah.
So if you need to move, don't wait for rates to move because it's just going to offset. So don't really think it's a great plan to wait for rates.
I've been telling my clients right now, if we're trying to time the market, you're about 3 months late because we're sitting here in March 2026.
Yeah.
Best time to buy would have been through October to mid-December of last year.
Oh, yeah.
Reason being, everybody's sitting on the sideline wondering what's going to happen.
Yeah.
And so I think a lot of times when you start thinking, is now a good time? You're probably late.
Yeah.
Nevertheless, second best time is right now. So have that conversation.
Yeah, for sure. Because you look at our home sales historically, you know, we're very much we just passed the bottom of our traditional market. January, February is when there's the least amount of transactions. Now we're on the way up. Typically peaks late July, early August, and falls back off from there. So now we're already back on the upswing. So you've kind of already missed the window if you're past February, but still a really, really good time before that post-spring break rush when everybody's trying to buy a house and get moves before school starts again this fall.
So with respect to rates, you're trying to time it. You really can't.
Really can. Mortgage rates move every day, all day long because they're based on an investment product called a mortgage-backed security, and you know, there's a lot of things that impact that. But in the moment in time, you know, I don't know how long this video is gonna last out there, but in the moment in time, we're at a time with the Iran war going on, and so a lot of volatility in the market at the moment. We've seen interest rates move 0.5% over the course of the last 10 to 15 days, and so there's just a lot of volatility in it day to day, both on economics and geopolitical issues like this. So trying to time the market is really not a great plan. We really emphasized to our clients a thing my grandmother used to say: "Bird in the hand's better than two in the bush." And, you know, we're old, so you probably had a grandma that said that as well. And so, you know, really getting locked into that rate, because at the end of the day, when you actually look at the math, you know, the difference in 0.25% for most buyers on an average house in our market, it's about $80, $90 a month. If $80 or $90 a month is going to make or break your home buying decision, you're buying too much house. You can't afford what you're about to buy because you got kids, I got kids. That's like an eating out. And if you can't skip one eating out to buy this house, something else is broken in your finances.
Let's unpack that a little bit more. So when we get into that conversation about monthly spend, financial outlay, I feel like a lot of people are concerned with the wrong point or data point on the chart. They're concerned about the rate, not necessarily thinking how it fits into the total financial picture.
Correct. And that's the big thing. That is really how does this fit into your overall financial plan?
How do you all address that?
Well, we look at it from a budgeting perspective with people, just using a general rule of thumb of you never really want to have a house payment that exceeds any more of 30 to 35% of your net pay. You start going over that, that's when the wheels kind of get wobbly in terms of getting out of other debts, saving for retirements and college funds and things like that. So we kind of start there, but then people have to lay their individual lifestyle over that. So I use the analogy of me and my dad a lot. My dad's a complete total homebody. You'll find that dude on a lake, in his garden, or on his couch 95% of the time. So if his house payment was 38% of his net pay, totally and completely fine. I got a really bad travel problem. I like to go places. I'm on a lot of airplanes. My house payment is actually on average I'm full commission, so about 18% of my average net pay, because I like to go and do and play. That's way more important for us as a family. So I do think you have to lay your lifestyle over that, but really thinking about that in the context of, okay, how does this payment fit into our life financially, for sure.
One thing I've heard you say to clients and to me is we need to have at least 45-minute conversation with one another, as opposed to log on, click a button, get a quote there. Is that where you start to unpack how does my life fit in with this purchase I'm considering making?
Always. Yeah, we always want to have that initial consultation with the client. It's no different than you guys on your side, right? Because, I'm helping people get the largest debt they're probably ever going to have in their life. You're helping them buy the largest thing they're ever going to buy in their life. So really, it is so important that they take that time to have a buyer consultation with you and your team, to have a buyer consultation to me and my team, so they can fully understand how this is going to impact them going forward, both on the buy side and the finance side, for sure.
I know I have a general list of expectations I hope that my clients can walk away from my consultation with. If they have a consultation with Benchmark Mortgage, specifically the Brad Hacker team, what should they expect to walk away from that consultation with?
Yeah, they're going to have a good general idea of how cost actually works. They're going to understand what it is to make a good financial decision when they buy a house, and they're going to be clear on their numbers. I think that's the biggest thing. When people aren't clear on their numbers, they're nervous about their house, right? They're not excited about the house because they're scared the house payment isn't going to be exactly what they thought it was going to be, or their cash to close is going to be more than what they thought it to be. Where we take the time to actually go over that up front, when they get to the fun part, that's getting out with you, getting to see the houses and do all that stuff, they're not nervous about it because they know what they can afford. They have a general idea of what that's going to look like. So they can just be excited about you showing them a house, not worried about, oh my gosh, is this a house I really, really love that I may or may not be able to afford.
Very key point of emphasis. I would so much emphasize on sit down, know the numbers, and then let's go shop. So you can focus on the shopping experience.
Yeah, exactly. Not have
how do I make this work after I find something that I think I like.
Yeah, absolutely. So now my turn. Question for you. Obviously, we've seen some numbers come out that somewhere, depending on the market, that roughly about 30% of all home buyers right now are actually paying cash for their property and not getting a mortgage from a guy like me. So a lot of my clients think, hey, can I really compete with somebody who's paying cash out there? So what's your answer to that? If I'm approved benchmark and you're going to show me a house and I'm going, man, I'm worried a cash buyer is going to buy this and I can't get it because I need a mortgage. How do you combat that? What do sellers actually prefer cash buyers? Is that a real thing or is that a myth?
I would say, making as much of a generalization as I can, everybody's always been told cash is king.
Yeah.
I have to always ask as a seller's agent, well, what type of cash are you offering me?
Right.
Like, what do you mean it's cash?
Right.
What I think a lot of people make a mistake on, a lot of that cash is not readily liquid available. Write a check, close as soon as title gets done.
Sure.
So if you're offering me that I could close in 7 days, there may be a small consideration to make there, because if I have debt on my property, it's black and white, it's math. If you could save me 3/4 of a mortgage payment, well, what's that worth, right? Average mortgage payments, whatever it is, take 3/4 of it.
Right.
Maybe there's a delta there.
Yeah.
All that being said, you're still most of the time not closing in 7 days.
Right.
Probably closing closer to 14.
Yeah.
Your all's team can turn loans pretty daggone quick.
Close to that, yeah.
So all that to say, if speed is what you thought you were buying, I'm not really that concerned about it. I'll flip it back to something that you guys do a phenomenal job in, your consults.
Yeah.
When you send me a pre-approval, and it's my listing, what do I also get from a buyer that's pre-approved with your team?
You get confidence. You know that if we say they're going to close, they're going to close. It's almost as good as cash.
So in that sense, I think it does fall back on that buyer's agent presenting it in a way with who their pre-approval is through, why they can put as much stock in it as solid, and presenting it appropriately to the seller's agent, who can then turn around and have that conversation with their client. So to answer the original question, I do not believe it's always true that sellers prefer cash.
Yeah.
We've had instances where people are pulling it from a brokerage account.
Right.
Not all brokerage accounts have withdrawal mechanisms that are equal.
Correct.
I could be looking at a cash offer that says you can close in 2 weeks, but until you tell the brokerage I am withdrawing this amount of money, whether or not you've had that conversation with them or not, or figured out if there are tax implications involved with that conversation.
Very true.
I may have to wait 3 weeks for that money to become liquid or able to become put into play.
Yeah.
So did I buy any time?
Yeah.
So I think there's a conversation there.
Yeah.
Short answer, I would say the right lender providing the right level of service and guarantee behind the work that they've done through the consultation and the approval process is the equivalent of cash. Yeah. If there's a random delta out there that says I can write you a check today, sight unseen, no inspections, okay. How often does that happen?
Yeah, very rarely.
Especially in the owner-occupied space.
Yeah, for sure. Maybe in the investor space. So I think that's a great point, and I think that's why it's such a really important deal to work with a great agent team like you guys, because really good agent teams tend to have really good vendors, really good partners, like us. They're not, we won't say any names, but those mortgage lenders where you push button and get mortgage and stuff like that. They're not dealing with them. They're dealing with good, local, reputable companies who actually are going to be able to help clients get to where they want to go.
Feather in the cap for you and your team, when I know I am competing against cash, the first thing as an agent I am doing is reaching out to that seller's agent to notify them, hey, Brad Hacker, Cameron Bailey, Benchmark Mortgage are doing the loan. Yeah. It's a fully pre-approval. It's done. Yeah. It's been reviewed. It's been looked at. Other than there being something that we don't know yet with due diligence or an appraisal issue, financing is all but done. Yeah, exactly. Versus that fly-by-night, click on a button, and then all of a sudden they get their disclosures and they're paying some astronomical fee that they weren't aware of. Yeah. That shows up how long into the process. Versus, hey, other than us doing the things that you're going to have to do normally with due diligence and appraisal, financing's square. Yeah. And I know you guys would be willing to backstop that and reach out to that same seller's agent and say, hey, I can tell you a little bit more about the person who has made that offer. Yeah, absolutely. And we have a $1,000 closing guarantee here to where if we pre-approve you and for some reason we blow it up, we don't close, we write a check to that client for $1,000, and in 23 years I've written one. So so we're usually pretty good at it. Putting your money where your mouth is. Yeah, absolutely. Right? There's a lot of people that say, well, we've done this, we've done that. You guys are willing to put that guarantee there. And you guys even have a rider that as an agent I can submit with my offer. Correct. And it's a rider to that pre-approval stating that guarantee. Yep. I, Brad, I, Cameron, I, Benchmark, have done what we are telling you we've done. Right. Because I, as a seller's agent, have also gotten pre-approvals that were expired, inaccurate. Yeah. Not going to say rigged or falsified, but leave that up to interpretation. It happens, But also, things change. Right. You guys have a very stringent policy on staying in contact with those buyers. Right. Once they've met with you, making sure, because life happens. Oh, yeah, for sure. You're following up to make sure jobs are still the same. Yep. Debt outlay is still the same. Yep. His credit stayed the same. And all because they have had a very world-class consult with you all, they understand what to do and what not to do, which we'll touch more on that in a little bit. But I want to shift gears with you into more down payment and let's say cash injection questions, right? Yeah. So the biggest myth in home buying, at least from my experience, and we can thank our parents and grandparents for this. Yeah, absolutely. I have to have 20% down to purchase. Yeah. What say Brad? Totally not true. Why? Totally not true. As a matter of fact, before we came in here today, I actually looked. I think we have only had, of all the loans that we've closed year to date, I think we've only had 3 clients who have actually put 20% down on their property. Where that comes from, where that originates from is that anytime you put less than 20% down on most loan programs, you have what's called mortgage insurance. And mortgage insurance is simply just insurance that protects
us, the lender or the servicer, from you defaulting on that property. One of the dirty little secrets is you actually get an even better deal. In order to qualify for the very best interest rates, you actually have to put 25% down. Now, the cool thing is that first, for first-time home buyers, there's several programs out there that either require a very low down payment, 3% in most cases, or the traditional FHA loan that a lot of borrowers use these days, which only requires 3.5%. In addition to that, one of the great things about Kentucky is we have an organization called the Kentucky Housing Corporation here that will actually allow you to borrow that money on a small note to cover that down payment at a very, very reasonable interest rate. So when you start to get outside of Fayette County, now you open the door. A lot of our surrounding communities, whether it be Nicholasville, Versailles, or even farther out like a Mount Sterling, then you get into territory for the U.S. Department of Agriculture's rural housing program, which is still a true 100% financing program that's out there, that's very, very popular in those outlying areas. And then always we have our loan for our veterans. You know, veterans as part of their benefit. It's something that we fight for. Something we take a lot of pride in is working with veterans here at Benchmark. You know, they qualify for 100% financing through their military service, and it's a true benefit that they earned, no different than their medical benefits or what have you. So there's tons of different ways to get into the property without 20% down. These days we have a lot of parents who help with gifts. We're seeing more and more people buying homes for their elderly parents. Well, we've got a program where if you're buying a home for your elderly parent and we can prove the elder parent doesn't qualify, then that's an owner-occupied loan for you, and you can put as little as 5% down. So there's lots and lots of different options. Like you said, our moms and dads and granny and grandpas and Dave Ramsey have all told us we need 20% down, when that's not true at all. And in fact, the vast majority of people we work with don't put 20% down.
Overarching thing I take away from that, for those of you who have heard that and people that have worked hard to dispel that myth, it's more about how does the purchase fit into my overall financial lifestyle.
Absolutely.
You can inject as much or as little cash as you want, and unless I've sat down and looked at the full outlay of where my money goes, where I expect 100%. It to come from, I really don't know until I've sat down with somebody like yourself who can be a navigator or a tour guide on which route makes the most sense for me.
Oh yeah, and the interesting thing is it's amazing how many times in today's world you come to me, you've saved a little bit of money to put down on a house, but I see you've got X amount of dollars in credit cards over here. But that money's actually going to be better used paying off the credit card debt, not putting it down on the mortgage. The mortgage debt's going to be tax deferred. It's going to be tax deferred. The cost of ownership of that debt is typically going to be less on a monthly basis, and it's going to be at an obviously much, much lower interest rate. Or maybe it's a situation where, you know, we preach emergency funds. You know, we both own homes. You had anything break at your house that you didn't know it was going to break? Yeah, that seems to happen to me fairly regularly with a 20-something-year-old house these days, and so. You know, it's really, really important to have emergency funds. That old line of you buy a house broke, it'll make you broker. We've both seen that happen to people. And so a lot of times it's, hey, you don't need to put it down. You just need to throw it in your savings account. That way if the roof leaks, the HVAC goes out, whatever, you know, it's not drama. It's an inconvenience, and you can handle it.
I get asked this question a lot from whether it be first-time home buyers or even second or third-time home buyers. How much money do I actually need to purchase a house?
Yeah. And that really varies individual to individual in terms of what that looks like, because you have, really there's 3 sets of costs when you buy a house. Okay, there's lender cost, whatever your lender's charging you to do the loan. Then you have your third-party costs. So this is going to be our appraiser. This is going to be their home inspector or their termite inspector. This is going to be the title agency who's doing the title search, and most lenders are going to require a title insurance policy on that. That's going to be the recording fees to the county. So you got all these third-party people that have their hand in the cookie jar that's going to get paid. And then you have the prepaids, and that's just if you're going to do what's called escrow, where you're going to have your taxes and insurance included in your payment. Most people do. You're going to have some tax reserves and some insurance reserves, and you got to pay for that first year of homeowner's insurance up front as well. So when you think about those 3 buckets of cost, lender, third party, prepaid, it can really, really vary based on size of house. It can based on, in Central Kentucky, it can base dramatically on county. Fayette County runs their tax bills fiscal, whereas every other county in Central Kentucky runs their tax bills calendar. So how much money they have to outlay for taxes can vary dramatically. Who you choose for your homeowner's insurance agent, because you as the consumer have the power to pick whoever you want. That can impact your cash to close dramatically. And then obviously from the lending side, do you want to pay a little more upfront down to get a little bit lower interest rate? Or do you want to pay less money down and maybe have a little bit higher interest rate? So closing costs really do vary individual. And that's one of the big myths, is that closing costs kind of one size fits all. But the reality is if we've got 10 families buying a house, every single one of those 10 families' closing costs is going to look a little bit different based on who, what, and where.
From experience I can speak to, you all have a presentation that comes along with, I receive after my consultation, where that is simulated.
Yeah, for sure.
Can you talk us through what the simulation looks like of the post-mortgage consultation to see where those fees are and how they're outlined?
Absolutely. Yeah, we just break them all out for them based on, again, those factors, where, how much, those types of things. So we give them a full breakdown. Again, it just goes back to what we were talking about again. If I'm worried about the numbers, I'm not excited about the house. So we want everybody to have a good understanding of how the numbers are going to look, and that's why we have a no dumb questions policy here. Just like your teams does. We always want people to ask. If they have a question, they see something doesn't make sense to them or looks like, because you and I use terms in real estate that might as well be in Greek to the average consumer. We want them to always reach out. So yeah, we give them a full breakdown on that on day one once we do our consultation to make sure they understand it going forward for sure.
Do the consultations with your team cost any money?
No obligation, no cost. It's just our way of making sure that we're helping people do this in a really cool way. And I tell people up front, look, you don't owe anything. You're not obligated to anything. This is all just about me trying to help you do this as the guy who's about to give you the largest debt you've ever had in your life. And at the end of it, you want to use us? Great. We would love to have you. But if you feel like you and your family's better served somewhere else, we'll part ways as friends and we'll wish you well. So, yeah, no, definitely no cost on that. How about you guys? Same question. You guys do a pretty robust consultation yourself. Is it cost anything to sit down with the Catalyst group and have a consultation to really learn how that home buying side? I'm the money side of it. You're the house side of it. What does that look like on your side?
So we prefer them the same way you do.
Yep, for sure.
On the front end, and not on the fly.
Yeah, that's right.
So when we sit down and do a consultation, we are going to emphasize what the transaction or the purchase process, since we're talking about buyers in this situation, is going to look like from cradle to grave. It always has the same segue, not because we get paid to say it, but because we know it will directly impact your experience with us and our team in a positive way if you have the consultation first with me and with who's giving them the money.
Yeah.
So that way we can focus on how are we going to buy.
Yeah.
When we get past, okay, it's important, everybody's on the same page, I need to have that mortgage consultation, then we get into more of the fun type conversation.
Yeah.
Why are you buying?
Yeah.
Are we expecting to grow our family? Are we needing less space? Are we needing to be in a certain geographical location?
Yeah.
Obviously, the price conversation is going to be stemmed from the education they get from you.
Right.
Sometimes they'll have a general idea based on what they currently spend.
Sure.
So I'm going to be making you think about, what are you currently paying in rent?
Yeah.
If you own a home, what does that cost you?
Right.
Not just what you pay the bank, what do you pay for utilities?
Right.
What do you pay for insurance?
Yep.
So I can start thinking through, okay, when they have their conversation with you, they don't do this every day, I do.
Right.
I can compare notes with you.
Yep.
Hey, did they mention that they're looking at a newer house?
Yeah.
That's important for you guys. Why? Because insurance premium might be a little bit lower.
Cheaper. That's correct.
So just things like that I can be asking the questions they may not know to ask, but also I can start developing a buyer profile for this box or this buy box we're going to be shopping in. So
for sure.
Location, price, motivation, those are the big things.
Yeah.
And then we can actually start looking at properties on the screen.
Yeah.
Let's flip through some photos.
Yeah.
Tell me what you like or what you don't like.
Yeah.
I always try not to overly filter my searches.
Right.
But that way I can start getting a feel for what gets you excited on the screen, because everybody shops on their phone first.
For sure.
And then we go put boots on the ground and figure out, okay, is it in the right area? What's the surrounding properties look like? But when we get done with that buyer's consultation, my goal is for everybody to have an understanding of what to expect, how this process works to best suit you. It's not about me. It's about the person who's going to be buying.
Yeah.
And then how are we going to make this work in the most seamless way possible? Because also you have to still work to pay for this place. So how do I work into your schedule? When's the best time for us to look at properties? How can I best communicate with you? So trying to have just a full profile of who I am going to be working with, so that I can make your life easier on the loan side, and most importantly, their life easier on the buy side.
Yeah.
And when we get done with that, it's a lot of information. So you're going to have us as a resource. We have a full-service real estate team who has tons and tons and tons of information that we can share with you to make that process as easy as possible, but also so you can come back and review things that you might have glossed over when we first met.
Yeah, exactly.
I want to unpack with you as far as we touched on some of in our cash to close conversation on closing costs.
Yeah.
But can you give us a definitive kind of look at what closing costs are and how much are they?
In terms of a specific amount?
I'd say just when you're looking at what goes into actual closing costs, right?
Yeah, generally speaking.
So the lender fees.
Yeah. Well, that's going to vary greatly lender to lender, and how your loan is structured, because we do loans with no lender fees if cash out of pocket is going to be a challenge for you. So they could be as low as 0 or as high as several percent of your cost of your home, if we got to buy our rate down to make sure that the payment fits into your budget. So it really is, again, it goes back, it's hard to put a number on it, just simply because it's so individualized to the client if you're doing it right, and it's one of the big things that I feel like most banks and mortgage companies do wrong, is they issue these blanket, this is what our closing costs are. Now, that may or may not be what's best for the client. So now, generally speaking, in Central Kentucky, depending on which lender you're talking to, you're probably going to be somewhere, and again, a lot of it has to do with purchase price, because the larger the loan, the larger that title insurance premium that you're going to be buying from the attorney is going to cost. But generally speaking, on an average home in Central Kentucky, low end's probably $3,600, the high end's probably $4,400, just based on how it's structured and what type of loan you're doing.
So again, knowing what all that entails on the front end, that can directly impact how you shop and what you shop for. So
absolutely.
What I take away from that is, don't click an online mortgage calculator to calculate your closing costs. Come sit down with somebody.
It's probably going to be wrong. Yeah,
come sit down with somebody who knows how to calculate them for you based on the questions you're going to get answers to about specifically what that individual is looking for.
Yeah. So let me ask you a question not on our list. So I'm throwing you a curveball here. There's been a lot of stuff in the media about how you guys get paid, and realtors and commissions and things like that. Big lawsuit last year and things like that. So if I'm a buyer and you're going to help me find a home, or somebody on the Catalyst team is going to help me find a home, how do you get paid? How am I going to pay you, or how do you get paid?
So from the buyer side, I'm going to sit down during my consultation and explain, this is no different than you hiring me to build a deck on your house.
Right.
I'm going to give you a proposal and an outline of what my job responsibilities are with you, but also what some of the responsibilities or the onus that the buyer has to me.
Right.
Part of which is paying my fee for my service.
Right.
There's no blanketed standard operating commission fee.
Right.
That was part of, or the crux behind, the original confusion that stemmed the lawsuit. People were saying, well, it's standard that there's 6% in every deal and I get 3%.
Yeah.
Bullshit.
Yeah.
I get paid all different ways.
Right.
It all depends on the customer, the consumer, the deal flow, the outlay of what all goes into it. But the same way somebody would quote you a deck on your house, I'm going to give you a scope of services and a scope of work which you can expect from me.
Which I think is awesome, because most agents don't do that.
I want you to know what you can expect from me.
Right.
So that if we ever don't have aligning expectations or deliverables, we can revert back to what was discussed and promised on the front end.
Right.
And then we can have a conversation.
Yeah.
Because everything is fluid until it's not.
Right, exactly.
So what we look at is, okay, for my fees, I will charge 3% to be a buyer's agent representative. I believe that the level of service that I can offer somebody, and I can give them stories to explain situations where I probably was underpaid on that job, and yet I didn't come back with a bill like you've probably had some contractors do and say, hey, there were some change orders.
100%.
If I did, I might not have to work, right? Because I could change order people today.
That's right.
All that to say, 3% fits into my personal viewpoint of what I offer to bring to that transaction. So therefore, I charge 3%. Now, how does that come to fruition?
Yeah.
you can pay it directly out of pocket.
Yep.
I've learned that because of the way consumer debt and structure of the
100%.
financial outlay,
Yep.
most people don't have the 3% to pay me. So what I will explain to the consumer is when we go out and look at properties and we fill out a purchase and sale agreement, there's a section on our new purchase and sale agreement that allows me to state within my offer what I am requesting that seller to pay me as far as compensation goes on behalf of the buyer.
Right.
Common misconception, who typically brings money to the table at a closing?
The buyer.
Seller is taking the proceeds from
Right.
their sale and out of that issuing a compensation to me, the buyer's agent, because we agreed to it in writing.
Correct.
So in an instance where a buyer may not have that funds available or chooses not to, we'll look to roll that up into the overall cost of the acquisition, of which the proceeds would break out the agreed to compensation that we've got signed documentation saying, this is what I'm charging, this is who's paying it. And the beautiful part for the homeowners or the soon-to-be homeowners is they don't have to pay it up front.
Right.
I'll promise you, and this isn't me being cocky, people would not pay my hourly rate if they had to because they wouldn't have it. And it's no knock on them. And I'm taking a real big risk anytime I sign on a customer because I may never see a dime.
You may never see a dime.
I'm willing to do it because I'm willing to work hard. I'm willing to earn it. And those monies get distributed at closing.
For sure.
It's the same way if I built your deck, right? I've used the same analogy. Once you've walked on the deck, you've inspected it and made sure it's fine, you can issue payment. Now, whether it's the buyer paying me or the seller paying me, to be determined.
To be determined based on the individual transaction.
Correct. So do you feel like that answers
the
question?
Yeah, that's a great answer. Great answer.
When we get into some affordability questions for buyers, a lot of times some people may say, well, I'm not sure if I make enough money. How much income do I actually need to buy a house?
That's going to vary. I mean, depending on debt structure, savings patterns, in terms of what do you put in your 401k, things like that. Are you married? Is this a 2-income household or a 1-income household? Or you don't have to be married. If you have a significant other that you're gonna buy with, or a mom or dad, we see a lot of parents buying houses with children these days and different things like that. So really varies. I mean, obviously. You want to be working full-time. If you're only working part-time, you will have to have 2 years of part-time history before you can qualify. So we have, for example, we recently did a loan for a part-time individual who was a part of wait staff at one of the very nice restaurants in downtown Lexington. They made really, really good money part-time, a lot more money than a lot of young people that I know working full-time. And she had been there a couple of years, and we were able to get her a loan on her part-time income. So are you self-employed? The name of the game for you self-employed guys is always, I want to make as much money as I possibly can and show Uncle Sam as little as I possibly can. So that's where we get into some what we call alt-doc programs like bank statements and different things like that. So it's hard to put a specific income on it. I think again, if you're following that 30% rule, if you're taking home less than about $3,000 or $4,000 a month household, it's probably going to be pretty hard for you to, not necessarily to qualify for something, but it's going to be hard for your team to find them something that they're actually going to want to live in at a price point that they can afford. So
unpacking that a little bit from my side, it really doesn't matter what you make. It's more what you can afford based on how much you make, which goes into lifestyle considerations, debt to income ratio, and then finding the appropriate property that would work. So it's not a one-size-fits-all. You have to make this.
You have to get in there and doing it.
But I'd say arguably, based on your conversations with consumers that have to come in and unpack all of their financial landscape, the savers, the more budget conscientious people have a better chance at finding a fit for them.
Absolutely. And a lot of times that's just looking in the mirror and figuring out, okay, what am I willing to let go of? Because if you're a 3-day-a-week Starbucks drinker, well, you're spending about $100 a month on Starbucks. The reality is that's going to buy you somewhere in the neighborhood of about an extra $10,000 to $15,000 in home.
Which could be the difference maker in a house being acceptable or not.
Not acceptable. So, that lifestyle question is really, really a big one.
This isn't on our sheet. I'm going to hit you with it. Consumer debt, we've touched on. It's probably the biggest threat to your or I's industry or our
100%.
job. 100%. Where do you stand on consumer debt today?
I hate it. I'm not a fan. It's always funny to hear the dude who gives you big, large debt for a living say he hates debt, but I'm not a fan. Outside of my mortgages on my properties, I don't have any debt on cars or credit cards or anything like that. I'm a credit card user, but I pay them off weekly. I don't even wait to pay them off monthly. So for me, consumer debt, and part of that is quite honestly how I was raised. My dad taught me if you don't have the cash to pay for it, you don't buy it. And then part of it's PTSD from being a mortgage guy during the housing crash. I don't know what it's like to almost go broke because you did play with fire too much on the consumer debt side. So for me, you want to eliminate as much of it as you possibly can. I think there is a difference between good debt and bad debt in that conversation. If you've got student loan debt, depending on what your degree field was in. So if you went to school and now you're an engineer or an accountant or an attorney or something like that, it's probably really good debt. You're probably getting a pretty good ROI on that. If you got a degree in underwater basket weaving, you're probably screwed. So that's probably bad debt there, Credit cards, obviously bad debt. For the first time in history in the United States, there's more credit card debt than there is mortgage debt. That's never happened ever, which means that the consumer is living on borrowed money. And I think we're going to see an end to that pretty soon. I think you're going to get to a point to where, Capital One's going to say, keep me out of your wallet. They're not going to say what's in your wallet. They're going to say, keep me out of it because you spend too much money with it.
Sorry, Charles Barkley.
Yeah, Charles Barkley. The Capital One man's going to be out of work. So I think getting rid of that consumer debt needs to be one of those ands. How do I buy this house and get out of all my consumer debt? Cars, the amount of money people spend to drive in today's world is really unbelievable. I met with a household a couple months ago to where they were paying $2,300 a month to drive because we said, I'm like, okay, well, what's your car payment? What's your car insurance? How much do you pay on gas? How often do you have an oil change? And we did the math on it. It's $2,300 a month to drive. To drive. They had some really, really nice vehicles, but
they want to live in those vehicles.
But they don't appreciate well. Car debt is one of the worst forms of debt in my opinion because you lose money twice on a car. Car's going down in value every single time you look at it, and you're paying interest on it. So you actually lose money twice on a car. So you want to try to get out of that kind of debt as fast as you possibly can.
Digging deeper on consumer debt, one thing I feel like I'm seeing a lot more on settlement statements when we're at closings, buy now, pay later.
Yeah. Yeah, and that's becoming a big problem in our world because, like, if you're at wherever and you Klarna your $125 Jordans or whatever the case may be, now that's a payment that shows up on your bank statement, and we have to count that against you in your debt-to-income ratio if the payments are more than 6 months. And so we actually had one of my other fellow loan officers at one of our other benchmark branches had a client who had 137 Klarna payments on their bank statements. When they went to get pre-approved. I think that's the record. But, yeah, it's the fastest growing segment of consumer debt. Klarna actually loans out $2 million a day right now. So, yeah, it's a problem. But I think it's just another one of those signs of the consumer is literally getting to the end of the rope, and we're starting to see people live more on borrowed money than earned income, and eventually, the rug's going to get pulled out on that, and that's going to be a huge problem economically.
Do buy now, pay later show up on a credit pool?
They won't show up on a credit pool, but they typically show up on your bank statement, and we're going to need to see a copy of your bank statement. And once we see it on a bank statement, now we got to verify it.
And that gets baked into the global debt-to-income ratio. Absolutely. You're looking at.
Yeah, because it's a debt. It's a debt. It's something you're paying monthly. So if anytime it has a payment repayment term more than 6 months, we got to count it in your debt to income ratio. So you definitely want to avoid buy now, pay later if you can. I saw recently that you can buy now, pay later your DoorDash. So I think we're getting to a bad spot if that's the thing.
Well, the connotation for the longest time was there's predatory lending practices.
Yeah, absolutely.
You can go to a college campus at 18 years old, get given a $5,000 unrestricted credit card, non-secured credit card, and then you can go make that decision when you DoorDash Jimmy John's to finance it out over 4 equal installments that are maybe they're interest free. Yeah. But if you want to truly borrow money and buy a house, you're going to have to at least disclose what that looks like. So
another interesting phenomenon that we're seeing right now with the legalization of gambling in the state of Kentucky is we're seeing a lot more so in young men than young women. A lot of people who are spending a ridiculous amount of money on sports gambling. And I'm not here. I like to throw a little juice on a game here and there just as well as anybody. But we had a young man a month before last where he made a very, very good salary. Pushing 6-figure salary. We show him the payment on the property. He's like, man, I don't think I can afford this. And we're doing the math on it. And we're like, man, there's no way in the world you shouldn't be able to afford this. Start getting into his bank statements. He had spent $2,300 on DraftKings the month before. It was $2,255 on DraftKings the month before, and just asking, and he was totally unaware with it. He was like, "Man, I don't know. I just do some live bets, transfer a little money in there." I'm like, "We're like, well, how much do you think you spent?" And he literally goes, "I don't know, probably $500-600, something like that." And we were like, "Yeah, you spent $2,200 last month on sports gambling." So, there's a lot of things in the world that are out there trying to access our funds from a lot of different places. Self-discipline in terms of money is really, when you look at the reason why, statistically, according to the National Association of Realtors, the average first-time homebuyer now is 40 years old. When I started doing this in March of 2003, it was 27. And so you think about that over a 23-year period, that average age of a first-time homebuyer has went up 13 years. And a lot of it is that these companies, these industries, man, they've gotten really, really good at extracting money from us. And there's a reason why these companies pay these influencers a lot of money to promote stuff to you, to get you to buy it.
It's definitely a big problem. And what I hear when you say the average age goes up, that's 13 years of lost appreciation you could have had
absolutely.
coming to you as a result of owning that home that you could have rolled into another home or paying off other debt or student loans. So I think a lot of people think about it's a place to live, and this is not to take any of the sentimental value out of having a home.
Yeah.
But when you start thinking about it as an investment vehicle that can allow you to go do other things,
Sure.
I think that can be a dynamic shift for a lot of people when they realize you could live somewhere for 5, 7, 10 years and look at that as a way to grow your overall net worth.
Yeah.
And let's say you do have something that comes up that you do need an expense for. There's options where you can borrow against the equity that you've generated to pay for that.
Absolutely.
Or if you wanted to go buy an investment property.
Yeah.
It makes it a whole heck of a lot easier to borrow from yourself because you made a good decision than it does to try to now go give that money straight out and just acquire it outright.
Yeah, and there's a lot of loudmouth experts out there telling younger people that don't ever buy your own home, rent forever, and it's just bad advice. I mean, anybody with a calculator can figure out that's not a great deal. And the reality is a lot of the people that are out there screaming that are the people that own all the investment properties and are invested in apartment complexes and things like that. And I think one of the things we always say to first-time homebuyers is you have to understand, no matter whether you own or rent, you are paying a mortgage. Like guys like you and I, we freaking love tenants because they pay our mortgage and we get all of the wealth out of it. They get zero of the wealth and they build wealth for us. That's why we love them. We love tenants, right? And so when we say that, it really does shift their perspective on, wait a second, yeah, I am living at apartment 5B down here in the apartment complex, but that REIT's got a mortgage on that apartment complex. And the reality is your piece of the rent is paying their mortgage. So whether you own it or whether you rent it, you are paying a mortgage, always. It's just, are you paying yours or somebody else's? All things being equal, the math usually ends up better you're paying your own.
Correct. When I get into affordability conversations, so a lot of buyers will look at homes before they know their true budget. Mm-hmm. We've talked on various points about sitting down, having the consultation.
For sure.
What would you say to somebody when they see what they can get pre-approved for versus their comfort budget and how that might be very different? Can you give us some examples of what that looks like?
Yeah, I think that's one of our challenges in this affordability. I don't want to call it a crisis, but it is kind of an affordability crisis, is what we call the gap. I love this house that costs X, but my budget says I can cost Y. And I think that's where that financial advice comes in so handy, right? Because our job is to start helping to close that gap. Your job as a real estate professional is helping, okay, you really, really like that house, but how much of that is want to haves versus have to haves? Because maybe it might be priced X, but we can get you in something that's actually going to work for your family for Y, right? And if we can combine that with, hey, did you realize how much you're spending on Starbucks every month? hey, you're driving a car that costs this. If we could get that car to cost this instead of that, now all of a sudden we start to close that gap and close that affordability piece. So I think that advice piece, I think as real estate continues to change and evolve on both sides, I think the people who are going to do really well, the people who are really going to make a huge impact in the lives of our clients are people who become advice driven and not sales driven, and really genuinely can help people figure out how to solve that problem in the gap between what they really like, because everybody starts with getting excited about a house. Like that's why consumers always start with you, Sheridan. 23 years, I've never met the first time home buyer who's excited to make their first mortgage payment. They're excited to buy their first house, right? And that's why they're reaching out to you first. Well, we know that the numbers bear out that by the time they actually call you, they've already been online looking at houses somewhere between 90 days and 6 months is what the statistics say. So they've already been building this dream in their mind before you or I ever meet them. And so we've got to be ready to help them in that environment.
How do you see people close that gap down? So if I come in for a consultation, what I want is X, what I can afford is Y, but there are things that I can clean up to close that gap down. Obviously situationally dependent, but at what point do you think people should begin having that conversation? You just said something about 90 days to 6 months of looking at houses.
Yeah.
I would argue if you gave somebody 90 days to 6 months, they could probably clean up some of the stuff on that sheet. What do you think is an average time you see people who will follow the play able to clean up some of that stuff to make houses become more affordable?
It depends on how bad they want it. And because I think one of the coolest things about the world that we live in right now is the gig economy. Like, it is not, if you want to make money right now, it ain't hard to make money. I can DoorDash. I can Instacart. I can do this. I can do that.
Can take pictures of my feet.
You can do that. I mean, those beautiful feet you have. I mean, God knows what you would get for those things. And so there's so many different ways in today's world to make money. If you're just willing to hustle a little bit, you can clean up a lot in a really, really short period of time. I've got a niece who put herself through vet tech school DoorDashing. She didn't take any loans at all. I think she told me she made, on a weekend, she would typically make anywhere between $250 and $300 a weekend, just door dashing on the weekends, and put herself through. So there's just so many ways in today's world that you can. I saw a deal the other day, something on kind of one of our local community pages, where there was somebody who was willing to pay somebody $100 to basically babysit an elderly parent. I was like, holy crap, we've got elderly parent babysitters right now. I got a kid who dog sits. And like, the amount of money that people pay somebody to sit with a dog, like, blows my mind. Like, my dog can stay at home by itself for $20 an hour. But there are people out there that will pay you $20 an hour to go sit with their dog so they can go have date night, because they don't have any kids and that's their kid. So if you just look and you hustle a little bit, it's pretty easy. I won't say it's easy, but it's definitely, and it's then you have to bring the discipline part of it into it. And then on the actual home piece of it, it's just really getting realistic about what you need versus what you want. I think a lot of the mindset of the younger home buyer, guys like you and I, we're a little bit older. We were just happy to buy a house, and like kids these days, they want to start where their parents are, and they don't realize that it took their parents like 30 years to get to that house. They're not happy in the 3-bedroom, 1-bath, 985 square foot little house that you start off in, that you build some equity in for 4 or 5 years, and then you sell it, and then you're in the next one, and then by the time you're 10 years down the road, then you got that house you're going to live in. The expectation. So a lot of it's just helping people, and I think that's the real estate agent's job, quite frankly, is to help people set realistic expectations about what they can and get for their money once we know what that number is, and try to maximize that.
So if you want to close the gap down, sit down, have the consultation, understand dollars in, dollars out.
Yeah.
Next to perceived goal.
Yeah.
And then there's a plan.
Yeah.
And then really it just boils down to willingness to work the plan.
Yeah.
And out of that consultation, if somebody's not ready right now, can they expect to walk away with a plan to become affordable on the house they want?
Yeah, we have a saying in our team: we don't tell anybody no, we tell them not right now. And we tell them what they need to do, whether that's a credit challenge or an income challenge or whatever the case may be. But from the pure financial side of it, it's just as simple as you either got to spend less or make more, and if you can do both, The faster that you spend less and make more, the faster you're going to get into your home.
And then you all are actually providing them with the advice. It's not you get pushed off to some call center that you check in with. They physically can check in with you guys, work towards the progress or the list that you've given them to get there.
Absolutely. Yeah.
And I know just because I've worked with your all's team, you all do check-ins regularly with people whom you've met with that have not yet purchased just to see if there's anything else
we can do. How's it going? That type of stuff.
Very cool.
For sure.
How would I go about figuring out if I hadn't met with you yet, but I was sitting there doing some bar napkin math or whatever on figuring out how much a $400,000 house costs per month?
Yeah, good rule of thumb right now with where interest rates are and where home values are is it's about $8 per month per thousand purchased.
Say that one more time for the people who need to hear it twice.
$8 a month for every $1,000 purchased. So if I go buy a $400,000 house, that's going to cost me roughly about $3,200 a month. Now, for you, it might be a little bit more. It might be $835 a month. For Emma, it may be a little cheaper. Maybe for her, it's $785 a month. If you've got a larger down payment, it's going to move that number. But as a good general, I want quick math in my head. I'm standing in a house with Sheridan or Dustin or Emma or Sarah or somebody on the team, and I want to be like, okay, this house costs X. If I multiply X times 8, that's going to give me a good general idea of if that's a payment that's going to fit in my budget.
Good. Moving into more credit and loan approval questions. So what credit score do you need to buy a home?
So that's another big myth. You don't have to have a credit score to buy a home. You can actually have a 0 credit score to buy a home. Makes it a little bit more difficult, makes it a little bit more expensive, but you actually do not have to have a credit score to buy a home. Now, most lenders will tell you got to have at least a 620 credit score to buy a home. That's what's called an overlay. It's essentially a rule over the rules. Most loan programs actually don't have a credit score requirement. So what we tend to look at is have you been clean for the last 12 to 24 months? When I say clean, you don't have any collections on your credit, you don't have any charge-offs, you've paid all of your bills on time, you don't have a crazy amount of debt on your credit cards, you haven't filed bankruptcy in the last year or so, just different things like that. So we always start there. I think credit score is a very unique thing. I use the analogy a lot of credit score is like my weight. When I eat like crap and don't go to the gym, I'm a fat boy and my weight goes up. All right? But when I'm eating salads and hitting the gym 3 or 4 days a week, trim and slim, I look like Sheridan Sims. All right? So credit, that's the exact same way credit scoring works. Pay your bills on time. Keep your balances low, you will have a good credit score. It's going to fix itself.
So don't let in your mind, negative credit score affect you from starting the conversation.
Absolutely not. Because a lot of times there's a very small, a lot of people think it's like a full turn of the wheel to get there. A lot of times it's just a few clicks. I mean, there's very little difference, for example, between a 580 credit score and a 620 credit score for most people. I got a collection on my credit I didn't know that was there. My credit card bill is maxed out and I just need to pay it down, or I haven't done a good job of reestablishing credit after I had some old bad stuff, touched the hot stove, don't want to go that again, so I haven't reestablished. And so usually it's pretty easy to get a few tweaks. The best thing about the ultra terrible, awful, consumer abusive credit scoring system that we have in the United States, I can't use enough bad adjectives to score our credit scoring models, is that it's stupid and broken. So if you understand how to manipulate it, it's stupid and broken. Like, it's not, you don't have to do a lot of stuff to have a very high credit score. I mean, I'm a guy that, again, not bragging or anything, I'm a guy with an over 800 credit score. I don't have any bills. So I pay my mortgage payments. I don't pay car payments. I don't really pay credit. There's months I don't pay credit card payments. I got a couple mortgages and I got a credit score of 800. So the myth is that you got to be in a bunch of debt to have a good credit score. It's just not true, or have a bunch of accounts or whatever. It's actually much easier to manage when you have less.
Sit down with somebody who understands the mechanisms that the score generates itself off of, and then you can figure out what levers to pull or how many clicks to spin on the dial to get it there.
Yeah.
So for those listening at home that are thinking, okay, my credit may not be where it needs to be, sit down, have a conversation, figure out how to get it there, because from my understanding, credit is just a piece of the puzzle when it comes to overall affordability.
Yeah, absolutely. Because, I mean, like you said, it's a piece. The old saying in banking is cash, credit, and collateral. How much money do you make? What's the house worth? And then your credit, or the money that you have to put down. If you got a bunch of money to put down, grandma God forbid, passed away and left you a couple $100,000 and your credit's crap, we're probably going to be able to still put you in a home because a big down payment cures a lot of problems, right? And so don't always disqualify yourself just because your credit score may be a little less than perfect.
So let's talk about what a mortgage pre-approval actually means for a consumer as a buyer, but also we touched on some of that, what it can mean if I'm on the seller side and I'm looking at a pre-approval.
Yeah.
If you're out house hunting without a pre-approval, you could be wasting time.
Valuable time.
What say you?
Yeah, I think that's 100% true. I think the biggest thing that gets mixed up is the difference between pre-qualified and pre-approved. Pre-qualified is, the best way I know to say it is told me and showed me, right? To get pre-qualified, what you tell me, you fill out a loan application, I pull your credit, you get a loan, you're pre-qualified. But you show me, okay, by providing me your bank statements, your paycheck stubs, your W-2s, your tax returns, whatever it is, all the 500,000 documents sometimes feel like we have to have, that's actually what gets you pre-approved. And that's one of those things that as a real estate agent, if Emma's going to make an offer on a house and she's pre-qualified, or I'm going to make an offer on a house and I'm pre-approved, that seller wants a pre-approved buyer. They don't want a pre-qualified buyer. So it's really, really important to get those documents into your lender as quickly as you possibly can, because things that come up that consumers don't think about. I'll give you a great example of one we had today. We had a lady tell us she had $15,000 available for her down payment. She did have $15,000 available for her down payment. It was in cash money, $100 bills, homie. The problem with that is that you can't use cash for a down payment on a house because it's not documented funds. We don't know if she got that money because she stole it or cooked meth or whatever, right? And there's this thing in the United States called the Patriot Act that says that any money that goes into a real estate transaction has to be verified to prevent money laundering. And so, we had to get creative in how we're going to get that money qualified to be able to be used. Well, in her mind, she had $15,000 to put down. She actually doesn't really have $15,000 to put down. There can be all kinds of things like that. Like, you may perceive that you work overtime all the time, and then we get your verification of employment. You actually only work overtime like 4 hours a night or 4 hours a week. Probably feels like a lot. I don't work a lot of overtime. I don't know if you do, but the reality is it's all overtime, baby. And so there's a lot of things. So you definitely want to get that pre-approval. You want to get your docs in, get fully pre-approved. We even go as far as what we call a pre-underwrite here.
What is that?
Sure, pre-underwrite, just make sure that we went on ahead and calculated everything. In a lot of cases, particularly with self-employed borrowers, we'll just have our underwriter go ahead and look at it and sign off on it, just to make sure there's not going to be any issues. Because again, like you said earlier, we're putting our money where our mouth is. Once we say go, we want to make sure that they can go, because we're not into breaking hearts, and we don't want to make people excited about something they can't do.
We've talked about consumer debt, good debt, bad debt. Something I get asked a lot is, can I buy a house if I have student loans?
Yeah, you absolutely can. I mean, obviously it goes into the debt to income equation. Typically how we have to count student loans is we're going to have to count 0.5% of your balance as the monthly payment. So if you got a lot of student loans, that can be a problem. So again, that's just one of those things. But yeah, absolutely. It's honestly unusual in today's world to meet people who don't have student loan debt. And the amount of student loan debt is just the high. You used to, if somebody had more than $50,000 in student loan debt, it would freak me out. And now I don't even blink an eye at $100,000 in student loan debt. So it's very, very common in today's world for people to have student loan debt. It's just a debt to income ratio factor. Now I think there's a lot of pieces to that, what things they should consider. But you definitely buy a house with student loan debt.
So getting into more mortgage basics. You've touched on this some in some of the earlier conversation, but what all actually is included in that monthly mortgage payment that I make every month?
So the key piece of it is what's called the PI, the principal and the interest. That's the portion of the payment that's actually going towards paying off the loan. Okay. Typically when you start out, if you're doing a 30-year mortgage, which most people are doing, about 80 to 85% of that payment's going towards interest. 5% of it's going towards principal, and it gradually grows towards principal the more payments you make. It's called amortization, and you can actually pull up a schedule. I do a really bad joke with clients a lot of times at closing where I'll give them their amortization schedule. I'll say, now hang this on your refrigerator and cross them off as you go. And they're like, hell no, I ain't doing that. And that's going to be the most demotivating thing ever. So the first piece of it's principal and interest. If you're putting less than 20% down, you're going to have to do what's called escrow. And escrow is just fancy mortgage mumbo-jumbo for savings account. So that means that your property taxes, they get paid to whatever municipality you live in, your homeowner's insurance that gets paid to whatever insurance company you choose to use. Those are also included into the monthly payments. Then there can be a couple other pieces. You can have mortgage insurance. So again, if you're putting 20% down, typically your loan's going to have some sort of mortgage insurance on it. Again, that's just insurance that protects the lender against you defaulting on the loan. And then sometimes we'll have HOA fees. Not real common here in Central Kentucky, but sometimes HOA fees if you're buying a condo or a townhome or something like that. Sometimes those can be included in the mortgage payment. The vast majority of time here, they're going to get paid outside of your payment. You're going to pay those directly to that HOA.
So on the consideration of things that are going into the payment, when I start thinking about budgeting for that, how much do you typically like to see people plan for if they're trying to budget and you're looking at their budget, they may be paying outside of that mortgage payment but still related to the house, like maintenance or utilities? Is there a rule of thumb or a budget item you have people include?
Yeah, I mean, for me, it's really about, it's more about just having the emergency fund established. I feel like you don't really, as long as you have the emergency fund established, and for disclosure, what we recommend is if you're a one-income household, you need to have 6 months worth of your net expenses. If you're a two-income household, 3 is okay. What does that look like? I don't think you need to necessarily put everything in that emergency funds, because if the crap hit the fan, you're not going to keep Netflix and go on vacation, like you would in your normal life. But the 4 things you can't live without is a roof over your head, clothes on your back, food on your table, and transportation to and from work so you can make money. So sitting down and going house, food, clothes, car, what does that cost me every month? I think if you're a couple that are both working and you got 3 months of that in a good high yield savings account or money market account, you've probably got all the money you need to handle anything that's going to happen at your house. Now, if you don't have that, now that becomes another and. How do I buy this house? And make sure there's enough money left over in my budget where every month I can put a slice of it into that emergency fund to make sure when water heaters blow up and roofs leak and things like that, I can handle that.
Very good.
Yep.
So, go ahead.
I was going to say, your turn. So, question I get a lot, probably question you get a lot is how long is this going to take? I'm fired up. I'm ready to go buy a house. What do we do now? How long is this going to take? How long is it going to be before I'm living in my new crib?
Least favorite answer, it does depend. I will say
it's a very popular answer today.
What it does depend on is probably the least fun part for most people, which is how quickly you're willing to take the steps to show me that you're willing to figure out how you're going to pay for this.
Right.
And it's not ever said or presented in a way that we don't think that you can.
Right.
We just know that oftentimes the hardest thing to do or the most challenging thing for people to get willing to do is sit down and figure out how do the money things work on the purchase.
Right.
A lot of times I have consumers that will send me a house. They don't ask me, hey, who should I talk to about how to pay for the house? They send me a house. That's a great conversation starter, and I will typically suggest we need to get a consultation on the book so that I can learn what is making the need for this purchase, right? The motivation. And then we'll talk about the how, which that's where you come in and say, all right, this is how we're going to make this work.
Right.
Because I know at the end of the day, I have had enough negative experiences where we skipped over that step of figuring out how.
Yeah.
I want to avoid that at all costs. So it's never me testing your ability. It's more show me that you're willing to do the hard part first in order to protect the experience over the course of that. Now, however long it takes for you to get to that point where you understand the financials of it, we're typically seeing somewhere between, and again, it really depends on people's budget and the availability of listings that fall within that.
Yeah.
But during your consultation, we are going to look at the amount of inventory available within certain silos or ranges of prices.
Yeah, or neighborhoods that they want to be in, areas, things like that, right?
Correct. But if you're looking at something that's sub 250 in Lexington, your options are limited.
Yeah.
And I would say that would put even more emphasis on the need to have your clip loaded with your bullets to fire at that offer or know what it costs versus if you're looking for something between 400 and 600,000 in Lexington, there's probably some more options out there.
For sure.
So we have a little bit more things to look at, which would uptick the probability we could find something that would be suitable.
Yeah. Big difference if you're looking in Mount Sterling versus looking in Lexington.
And so I think that just goes back to it depends on what the criteria is, but also the client's willingness to take the steps necessary to make the process more realistic. And then from there, it's a matter of, I'm going to actively look at properties with you. Our team does a very good job of sitting down with the customers either during or post showings to figure out what'd you like, what didn't you like, scale of 1 to 10, where do you rank this house? If it's a 7, what would make it an 8? If it's an 8, what would make it a 9? If it's a 10, as long as they've done what they need to do with you, we're going to write an offer.
We're going to pull trigger.
So I think it really does come down to what level of preparedness that client is willing to take themselves to in order to make the purchase a reality. On average, I would say if I had to pick a number, I'd say from the time you reach out to the time you close, we're probably talking about a 3 to 5 month cycle.
I think that's fair,
And then really just depending upon all the variables we just discussed.
Because that underwriting process, once you start the loan, actually after you go into contract, usually ends up being 20 to 30 days in most cases.
So once we get to the point where we have something we're under contract on, timelines get a lot more definable. Let's talk about things that you and I have both had pain around. Some things we should not do before we close on a house. So what would you say are your top few things don't do before you purchase the house?
I mean, the number one thing is borrow money. Do not borrow money for anything, on anything, anywhere, ever, never. No new credit cards, no new Klarnas, no new cars. God, I've had all kinds of crazy stuff. That's probably the number one thing. Don't quit your job. I know that sounds crazy, but you would not believe how many times we've had somebody quit a job, resign from a job because, hey, I'm getting a better job. I'm going to be making more money. Okay, you just made this exponentially more difficult to get done if you change jobs in the middle. It's just not an automatic no. So if you're a teacher in school district A and you move to school district B that's going to pay you $20,000 more a year, okay, that we'd probably figure that out. That's probably not going to be a problem. But if you're Billy Bob the police officer and you go to the factory to work because you're going to make $10 more an hour, well, guess what? You just had a career change, and that's going to be a problem. So
let's talk about that some instances of let you know if you're considering a job change or get proposed a job change. Then from there, what I heard you just say there is, so long as it's not a complete career change.
Same line of work's okay. Don't change careers.
If there is a gap in employment, I've seen that create problems. If it's a streamline or a transition from you maintain that job up until the point your new starts, what do they need to show you or give you to bridge that gap so long as it fits within the other criteria?
A lot of it's just hire letter that's going to define timelines, things like that. Big thing is just clearing contingencies. A lot of professional jobs will require you to pass a background check, take a drug test, those types of things. You know, we got to make sure that we can't just approve you and then you fail your drug test. That would be bad. So we got to make sure that any contingencies in your new hire letter or contract are cleared. But generally speaking, if you're moving the same line of work, you know, more money's never a problem, less money is. So as long as it's more money, you just got to give us a heads up before you do it so we can be prepared for it. If it's a career change, that's a problem. And another big one is going from a W-2 environment where you're an employee to becoming a contractor. So like we've had a couple of nurses. Travel nursing is very, very popular today, and it pays really, really well. But those are contract jobs. So you go from being employed to being self-employed, and now all of a sudden there's going to be some wait time for that before you're going to be allowed to be able to do a loan.
From an underwriting and closing mechanism, you all are going to do what's called a VOE or a verification of employment.
Correct.
Both on the front end and on the back end?
Yeah. Usually 48 hours prior to close, we're going to double check, make sure you didn't quit your job. You know, we're about to loan you several $100,000, so we want to make sure you still have the ability to pay for it. That's and shockingly, that's sometimes where we find out that people quit jobs. Is 2 days before closing, they moved jobs and just thought that wasn't a big deal and didn't tell us. So, no new debts, no new jobs. Are the big ones, and don't move large sums of money around. You know, if you were planning on putting $10,000 to it, and you just drop $10,000 in your checking account, that's going to be a problem again. We don't know if you stole it or grew weed or whatever. So we got to make sure that you obtain that money in a legal way to make sure that everybody stays kosher with Uncle Sam.
Very good.
Yep.
Let's bump into some rapid fire, little bonus hitters for the consumers there.
All right, rapid fire, here we go.
Can self-employed buyers get mortgages?
Absolutely. Sometimes more difficult just because, like we were talking about before, Name of the game is to show as least money to Uncle Sam as possible. But the bad news is if the IRS can't see it, I can't see it. But in today's world, there's lots of alternative programs for that. Very popular program is bank statements, where we use your bank deposits as your income as opposed to your actual income and get it done that way. So, yes, you can get a mortgage. Just be careful.
Can you refinance if rates drop later?
Absolutely, and we love it. We get paid to do loans here, so we would absolutely love to do another loan for you and help you save some money when you do it. But yeah, we actually have a process where we keep an eye on that for you. So if national average rates get 0.75% lower than your rate, you pop up on our radar. We're letting you know you're on our radar, and then once it goes to 1%, we're reaching out and doing a review.
So instead of them figuring out how much they can save, you can figure that out for them to where there's a break even and it makes sense.
Correct, yeah, and we provide them with all that data.
Touched on this some, quick and dirty. What is mortgage insurance?
Mortgage insurance is a premium that you pay that protects lenders against you defaulting on the loan. It just ensures that the lender is going to get their money if you throw them the keys. If you put at least 20% down, you don't have to pay it. There are a couple of other mechanisms to get out of it, higher rate, different things like that. But it's just a insurance policy, no different than if you wreck your car, you have insurance. We got insurance to make sure if you wreck your mortgage, we get our money back.
Should buyers wait for rates to drop?
We already talked about that. No, definitely not. I think when you, particularly in Central Kentucky, when you look at how much homes are appreciation, at best it's going to be a wash. At worst, you're probably going to end up costing yourself money.
Is getting pre-approved hard?
No, it's actually really, really super easy. Typically, it's 10 minutes on a website or 15 minutes on a phone call, and then upload a few documents, and we're ready to rock and roll.
So I want to touch on just a couple of segments that I think you and I have had a lot of conversations on, but a lot of people don't understand. Let's jump to mortgage rates explained and what can actually move rates.
Yeah.
So they move daily,
every
intra-daily.
Yep.
Now, one thing that's not on here that I have had some conversations with clients about, there are certain instances where institutions will have a daily rate, but then there's other institutions that the rate can float throughout the day and change. What is the distinction that causes that?
Just the individual, just the individual institution who wants to manage that. So typically, institutions that have a daily rate, their rate is going to run a little bit hotter because they're taking on the volatility of the market themselves. So you may see those institutions have a rate that'll run generally somewhere between 1/8 and 1/4% higher than where you could get it somewhere else because they're going on ahead and padding the risk of the market into their pricing for that particular day. Again, I think so much more of it has to really do with the individual, but on a day-to-day basis, there's just a lot of economics that play into it. In today's world, inflation is a huge part of it with what we've got going on right now with this particular conflict, the price of oil. I don't know if you've ever seen the clip of Landman when he's going through all the different things that are in oil, and it's basically everything in the world has oil in it. And so when the price of oil goes up, the price of everything goes up. Inflation is the enemy of bonds. Mortgage rates are based on bonds. So you've got that piece of it. Obviously, what the Federal Reserve is going to do. The markets are always trying to get ahead of the Fed. So if they think the Fed's going to lower rates, you'll typically see rates come down ahead of an actual Fed rate cut. Then mortgage rates will almost always spike temporarily once the Fed cut rates. It almost has the absolute effect. Fed rate impacts consumer debt, credit cards, car loans, home equity lines of credits, different things like that. So Fed policy has a big piece of it. Day-to-day bond market movements, a lot of things that impact that, whether that's stock appreciation. Stocks and bonds do compete for the same investment dollars on a daily basis. And then geopolitical, right? Things like what's going on right now, things that happen in the world, definitely have an impact on markets as well.
So you cannot lock that rate without a contract.
Correct. Yeah, mortgage interest rates get locked on properties, not people. Back in the good old days or bad old days, depending on when you look at it, there used to be a lot of what was called lock and shop programs where you could go ahead and lock in your rate, shop for a thing, find a house, if rates went down, you could float it down. If rates went up, you were protected, but those are pretty much out of the market now. There's just too much volatility in the market right now for most lenders to take on that kind of risk.
We've touched on some of these things, shifting gears towards the first-time home buyer group of folks again.
Yeah.
What would you say are some first-time home buyer mistakes to avoid?
Yeah, on the mortgage side, I would definitely say, again, job changes, depositing large sums of money, taking on any new debt, borrowing money in general. Those are usually the big ones. What about on your side? What are some of the big first time home buyer mistakes you try to get people to avoid?
I think the biggest thing on the front end is the sheer hesitancy to sit down and figure out what it looks like.
Yeah.
I think the same paralysis by analysis that plagues a lot of other industries hits ours, where people think because of what they've heard on the news or they've read online, houses are not affordable. Yeah. Houses cost too much. Yeah. I mean, you don't know until you sit down and figure out what the path from the math shows you. Yeah. Can you really do this?
Yeah, absolutely.
So I'd say that's the first mistake. But then once you get out in the field and you're looking, I think making too many unfair assumptions about the way houses either maintain or have not been maintained.
Right.
So I think just being realistic about the type of house you're looking at and what you can expect. It's not that you're asking people to purchase a lemon by any means, if I'm making a car analogy.
Right.
And time and money fixes a lot of things.
Absolutely.
So understanding who you're working with and their ability to help you maximize your money, save you time, or take the two and stack them together to purchase a property that may not be 100% what you want, and you can get it there over time.
Yeah.
So looking at it as an opportunity to make money over the long term, somebody who may be a little bit more handy, that conversation lends itself to.
That's a great point.
Somebody who may not be as handy, well, maybe we don't need to look at houses that are in this particular area or in this particular price range or this particular construction style, because you're going to have to pick up the phone to tell somebody the difference in a Phillips and a flathead.
Right.
That's okay.
Right.
We just might not look at certain types of properties.
Yep.
Those would be my two big ones. And then I think the third would be during a purchase, getting overwhelmed by the inspection report itself.
Yeah.
To the same tune of time and money can fix everything.
Yep.
I think I make the most headway with clients when we simply back up and we don't just look at it as this seller has done anything wrong or this house has failed.
Right.
We still want to buy a house. Seller still wants to sell a house. If these issues that arise through due diligence, and thank God we have a due diligence period, if it's something that is going to require to be fixed for any buyer, not just us, let's at least have the conversation.
Yeah, and I think that's one thing you all do amazingly well is setting that proper expectation on the front end of there's no such thing as a perfect house. We're going to hire this individual to go in and find something wrong with it. They're going to. And so you guys do an awesome job of just preparing people for that and setting that proper expectation to be like, hey, there's going to be things on this thing. We're going to have the ability to work through them. All right, from your perspective, we all know that you and I are terribly biased when it comes to this question, but we get it a lot. And again, like we said, we got a lot of loud talking influencers out there on the internet. Should you rent in today's market, in your opinion?
I would say if you can afford to buy, you should buy.
Yeah.
And so it's not to say yes if. And that being said, if you can afford to buy something, buy it. It's not your forever home.
Right.
If I had $1 for every person that said they were going to stay somewhere 10 and they called me in 2 and needed to sell,
yeah, no kidding,
I wouldn't necessarily have to work as much.
Yeah.
So I think to that end, if you plan on being anywhere for a 2 to 3 year period, I could make sense in any scenario, so long as the math works and it's affordable within their lifestyle and their budget, you should 100% buy.
Yep.
That being said, I think a lot of people, they sit back and want the $500,000 house when they can afford a $275,000 or $300,000, and don't realize that the same house that I bought for $125,000 is now worth $275,000.
Yeah, exactly.
Outside of regular routine maintenance, I haven't done anything to it.
Yep.
But I've generated wealth of 6 figures by what that's done. Now, in that time frame, I have chosen, just because my personal belief on the subject, to convert that property into a rental property. Yep. And because it was the first house I ever bought, it stayed on a 30-year note.
Yeah. Bonus, baby.
Bonus. The payment was $730.
Nice. And what does that house rent for today?
$1,850.
Yeah. So that's a nice little side income that comes into the Sims household from that first house.
But let's say I didn't want to be a landlord.
Yeah.
And that property did appreciate.
Sure.
I can sell that. Everybody always says there's no such thing as free money, with the exception of an owner-occupied sale that does not qualify for capital gains tax.
That's right.
That is free freaking money.
Free money.
And I can turn around and come to you and say, hey, Brad, my wife and I, or maybe I was single when I bought it, I'm now married, or my job has changed, I need more space. I can take the 6 figures I have and inject it into my new purchase without changing the lifestyle that I've created, and I can get more house.
Yeah. So, what are some of the lifestyle differences? Because you kind of have dual perspective, right? You as a landlord, what are you not going to let your tenant do? That if it's theirs, they can do whatever they want, right? So what are some of those lifestyle benefits of owning the home versus renting it?
Well, you can manicure and take care of your yard, right? I'm gonna go rad dad for a moment, but like if I rented a place, I'm probably not as concerned about putting out some good-looking perennials out front or edging the sidewalk, right? So I think there is, not to go too far off the reservation, but God made us to work.
Yeah, pride of ownership.
And so having pride in what you own, taking pride in it. Well, guess what? In doing so, I'm also improving the curb appeal so that if any point I ever decided to sell, I can improve the chances of me getting top dollar for the property. Whereas if I do that in my rental, all I've done is maybe I get the satisfaction of doing that in my yard and the work, and I'm never going to really reap any material benefit of that, right? Another example might be simply doing things like maintaining the property that are easy things, but I'm going to make sure they don't cost me as much money, right? Because everybody thinks, well, if something breaks, I'll call the landlord. Coming from a landlord, if you break something in my property, you very well could get billed for that. And if I have to replace something and a lease comes up, what do you think's happening?
Yeah, lease is going up.
So all that to say, you stay in control, right? If you back it up to like the sheer core principle of it, owning the house, you're in control. So I mean, what would you say from that end?
Yeah, I think it's just pure appreciation. I mean, I feel the numbers say this isn't. I feel like that the cornerstone of building wealth in America is homeownership, and when you look at the numbers right now, statistically, the average net worth of a homeowner is 10 times higher than that of somebody who rents, because it goes back to what we said a minute ago. Whether you own or rent, you're paying a mortgage, so you're going to pay that mortgage payment either way. You're either going to pay mine or you're going to pay yours. I'll be thrilled either way as a landlord, quite honestly. But all things being equal, I just assume they pay theirs, and you're going to get that appreciation. That house, particularly in Central Kentucky, but over time, really in any market in America, is going to go up in value. And so, what else are you going to buy that you gotta have? You have to have a roof over your head. There isn't, I guess you don't have to have, but you really should have a roof over your head. All right, well, if you're going to have one over, and again, all things being equal, if I can buy it for what I would rent it, then get that 3 or 4% that thing's going to go up every year. Take that for you and take that for your family. Don't give it to me or don't give it to you. We want you to have it. Now if you can't, we're happy to put that roof over your head. But again, all things being equal, I think that's really the magic's in the math. And really just looking at it, and we show every client, every first-time home buyer, a 10-year projection of where they're going to be. And, and I just ask them, hey, if you just keep renting and you don't go buy this house, how much of that number, that six-figure number that you mentioned, how much of that do you get? And the answer is zero. And you can just kind of see it click in their brain, the light bulb come on and go, okay, yeah, we need to be doing this.
Something I get asked a lot about from the non-owner occupied space, but buying an investment property or, let's call it a long-term or a short-term rental.
Sure. What
do the financing differences look like, owner-occupied versus non-owner-occupied?
Yeah, so you're going to have a lot more money down in most cases. Most cases you are going to have a minimum of 20% down on those properties. Some banks will allow you to put a little less down, maybe 10 or 15%, but you're not going to get quite as favorable terms on those loans. Opens up a whole nother loan program where it's called a debt service. DSCR, debt service credit ratio. We're just comparing the income of the property to the property to make sure that the property is going to cash flow. And those loans are carry a little bit higher interest rate, but they're very, very easy to do. And so we don't have to get into a lot of the financials and different things like that. Those have became immensely popular over the course of the last few years, particularly in the short-term rental space. I know here in Fayette County, you're kind of limited to some short-term rentals and different things like that. But if you're thinking about buying that quasi second home investment property on the beach that you want to buy, we're doing a lot of those right now down there. And so there's a lot of different impacts, but the main thing is just you're going to have a little bit more money down. Interest rates do run a little bit hotter, but the investment property game is really a cash flow game. We just want to make sure that you're going to put out X amount of dollars, it's going to bring in X amount of dollars, and usually that's what from a financial perspective, that's usually what determines what's going to make that a good property. Because for me, in my personal investments, the people that I advise on real estate investments, you really have to decide, are you going to invest for cash flow or are you going to invest for appreciation? Rarely are you going to do well at both. So, I've got a property that I make very little money on, but it's a rock star appreciating property. It goes up in value every single year. So I know that 10, 15 years from now, when it comes time when I don't want to fool with that property anymore, I'm going to have a boatload of money that I'm going to be able to roll out into some other investment for sure. What do you think it is how do you find those good investment properties? If you got an investor, you're working with me, I want to come to you, I want to buy something, what are the type of things you're looking for on those?
Passing the math.
Yeah.
Does it pencil? So that's what I was getting ready to touch on with you is I see a lot of people who are selling what have been investment properties with active tenants in them.
Yeah.
And they advertise them as immediate cash flowing properties. And I'm not a savant at math by any means, but right. I know credit to my father for kind of teaching me some core principles on pricing out a deal. Just if you see something listed, figure out what it rents for. Yeah. I generally know what they're looking for in terms of like, I can't really run off the 1% rule like I used to.
Right.
It's a rough way to start.
Right.
But I see a lot of people who, let's say you've got a duplex listed for $265,000, yet you're only getting $1,000 aside.
Yeah.
I'm gonna have to put how much down? Yeah. I'm gonna put a lot more down than 20%, right? I generally plan on having to put 20 to 25% down. Yeah. But I see somebody advertising something that says it brings $2,200 global income, but you're asking $265 for it. There's quite a wide delta there.
Big difference between gross and net there when it comes to those type of things. What about condition? Is it a lot more important one condition, or do you feel like that's a little different game than what it is for maybe somebody who's going to be moving into the property?
I'm probably a good and bad person to ask this question to, but I mean, everything has a price. Yeah. So with respect to an owner-occupant situation, time can be on your side. Yeah. I know that immediately once I take possession of an investment property, I have to then turn around and make income on it. Can I ask the same amount of rent for a place that has mold in a crawl, a bad HVAC, a water heater prone to leak, aged appliances, a bad roof, right? I have to immediately be thinking about the phone calls I'm going to get, or you, if you're my client, are going to get once somebody moves in there. Man, I'm giving you $1,400 a month, and I got water running through my ceiling. Yeah. Well, who's taking care of that? Yeah, exactly. Well, probably not a property manager if you bought that $265,000 duplex making $2,200 a month because you can't afford to pay a property manager. So that's you. Yeah. So that's where I try to sit down and say, do you want to be? There's no passive income in rental properties, right? That's the biggest horse shit I've ever heard marketed.
That's probably the biggest myth in real estate.
Doesn't exist. I got the calls at 3 a.m. to prove it. Yeah. All that to say, it can be a huge wealth-building vehicle
for sure.
if you learn how to shop. So I'm looking at things like what are deferred maintenance items that are going to cost me over the long term. Because as a homeowner, owner-occupied, you can ride some of those things out. Right. You can ride a fogged window out. Right. You can ride a busted latch on a window out, but I can't rent that to you with a busted latch that in the event of an emergency, when I'm not there to get you out, you can't get out of the house. So I have to go ahead and start figuring, okay, purchase price, less what I got to put down, less what I got to do, and then figure out what that delta is between what it would rent for right now versus what is market rent if it is improved. Yeah. There's no perfect science to it, but if you've done it enough or you're partnered with somebody who can help you guide into, what are some little tweaks I can do to immediately raise rent value to justify paying this price? Or here's the thing a lot of people don't think about, the same thing on owner-occupied or non-owner-occupied. What can I negotiate with the seller? Right. Hey, I can get you to a number, and I'm going to have some things or some concessions to help me do these things. So if I'm not concerned about how much I'm borrowing, bake that into it and take it as a credit. Now, if I'm paying cash, I'm just going to try to get the best deal possible on the front end to keep taxes where they need to be for the long term. But I would say I'm just looking at things that I know I have spent money on, whether it's on my house or a house that I've rented to somebody. Same. And where are my blind spots and how do I negotiate those into? Yeah. There's a lot of people that make that harder in today's market because anybody with a tool belt and a truck has turned into a landlord. Yeah. And there's some people who are willing to pay $260,000 for that. That's worth $220,000. Right. I love my investors though because it's very quick and dry. Yeah. Like it either works or it don't. Yeah.
It's just math at that point. The emotion stripped out of it.
What do you make? What's the ages of things? what's wrong with the property. Let me get to a number that I know I can go to the bank and get my loan done, because it's not that I want to do your job, but I've had enough conversations with you to understand what you're going to ask me for. And I don't really see it as the best investment right now to go out and try to put 40% down on a property just to make it work with the current cash flow.
Right.
Any advice you'd have for people shopping for for a investment property, just from like the sheer number side?
Yeah, the same. I mean, everything you just said. It's really it's a math equation. Just making sure that the math makes sense. Looking at that, I think a lot of things that realtors don't take into consideration a lot of times is the appreciation rates. I think with investment properties, you always have to begin with the end in mind. You know, if you're going to acquire this property, is this a property you want to own for the next 10 years, 15 years, 5 years? What's your goal here? You know, is that so? I think that's a piece of it. A lot of times that you have to throw into the equation, because I tend to invest in real estate more for appreciation as opposed to cash flow. Obviously, I want it to pay for itself and generate a little bit of money, but I don't typically buy a piece of property that I don't plan to own for at least 10 years. And so for me, that's a big piece of it is what is the appreciation projections. No, again, not an exact science. Nobody knows exactly how that's going to go, but I want a pretty good appreciation rate out of it, just simply because when you compare apples to apples and just the math of it, I put my money in the S&P 500 and make 10%, and historically that's happened for the last 70 years. So I need that property to out-earn what I would earn just having it as cash in the bank or in the markets in order for it to make sense for me.
And then I think you look at, too, who is the borrower, because there are certain, and this is obviously not tax advice, so please hear me when I say that.
We'll make Emma put the disclaimer on
there are tax advantages to owning property versus owning a stock.
Absolutely.
Right? I can't write off my computer and my mouse pad for purchasing or trading in options or whatever.
Correct.
However, I can write off the fact that I had to replace an HVAC unit or the mortgage interest that I paid on that property.
Whatever.
So there are some strategies to that if you've considered this versus that, it's at least worth a conversation and exploring.
Absolutely, but that's really what it is. The magic's in the math when it comes to investment properties.
You got anything else you want to ask me?
I don't think so. Was there anything else on here? Did I get it? Did we get it all?
You've hammered it, buddy.
Sweet.
It's good.
That's good stuff.